Welcome to vTalkInsight, Risk Sentiment Daily for March 24, 2026. A surprise pause in planned U.S. military strikes on Iran has ignited a powerful relief rally in equities, even as an historic Middle East energy shock and higher global yields keep volatility uncomfortably high. Let us unpack how this collision between de-escalation hopes and persistent macro risks is shaping today's fragile risk-on mood across assets. After several days of pronounced risk-off, today's tone has flipped toward a fragile risk-on backdrop. Major equity indices have rebounded sharply, and credit spreads have tightened as markets react to signals of temporary de-escalation between the United States and Iran. That rebound comes on the heels of heavy losses in Europe and Asia, where indices have endured their weakest month in years amid the Middle East energy shock and mounting macro uncertainty. Despite the bounce in stocks, volatility remains elevated across equities, bonds, and commodities. Oil has swung violently, with Brent crude dropping back below $100 after double-digit intraday moves, while gold has sold off even as geopolitical risks remain high. Rates markets tell a more cautious story. Front-end yields are still near multi-year highs after a 60 basis point surge, and bond market volatility suggests investors remain nervous about both inflation and growth. Overall, today looks like a relief rally rather than a regime change. De-escalation headlines are encouraging investors to add back some risk, but the underlying energy shock, tighter financial conditions, and geopolitical uncertainty keep the balance of risks skewed to the downside. In that context, the dominant tone is fragile risk-on. Price action is positive, yet conviction is low and highly dependent on the next set of geopolitical and policy signals. De-escalation hopes supporting risk assets are the clearest bullish force today. The U.S. decision to postpone potential strikes on Iranian energy infrastructure for several days has been interpreted as a meaningful step back from the brink. Equities responded immediately. Broad indices jumped well over 1%, with all 11 major U.S. sectors participating and more cyclical areas such as consumer discretionary and materials leading the move. The same de-escalation narrative has knocked the geopolitical premium out of key commodities, at least for now. Oil prices, which had surged more than 50% in just a few weeks, dropped sharply as hopes for ceasefire talks and increased use of strategic reserves eased near-term supply fears. Gold and silver extended a multi-session decline, falling as much as 5% in a single day as investors unwound safe haven positions and rotated back toward riskier assets. However, this relief is highly conditional. Iranian officials have publicly denied meaningful talks, Marines are still deploying to the region, and more than 40 energy assets remain damaged, which means the underlying conflict is far from resolved. Market commentary suggests that a sustainable improvement in risk appetite would require tangible signs such as fewer drone strikes and safer passage through the Strait of Hormuz. Until then, de-escalation hopes can support risk assets, but any adverse headline could quickly reverse today's gains. Resilient U.S. tech and AI leadership remains a second important bullish driver. Despite sharp swings in indexes, large-cap technology has continued to show relative strength, helping to stabilize broader equity performance. Recent episodes saw the Nasdaq outperform on up days, and even during sell-offs, tech-heavy benchmarks held up better than more cyclical or financials-led indices. Under the surface, the AI and data center theme continues to provide a structural growth narrative. Estimates suggest that over 100 gigawatts of new U.S. power generation may be needed to meet rising data center demand, equivalent to powering around 20 large cities. That demand is driving investment intentions across semiconductors, cloud infrastructure, and power-intensive computing, which helps explain why some allocators maintain tactical overweight positions in AI-related stocks despite recent valuation resets. That said, this leadership is not risk-free. Tech valuations remain sensitive to higher discount rates, and today's hawkish repricing at the front end of the curve raises the bar for future earnings growth. Energy and supply chain disruptions also pose a threat to AI hardware and data center operators, particularly if oil were to spike toward $150 as some scenarios suggest. The key watch point is whether tech can continue to deliver earnings resilience in an environment of higher funding costs and elevated input prices. Energy transition and infrastructure tailwinds form the third notable supportive theme. The current shock has underscored the strategic value of reliable energy supply chains, particularly liquefied natural gas produced in politically stable regions. U.S. LNG is increasingly viewed as a secure option, backed by strong military protection and existing export infrastructure, which enhances its role in global energy security frameworks. At the same time, surging data center demand is reshaping where value sits in the energy complex. Market signals, such as capacity auction prices in key U.S. power markets jumping to multiples of historical levels, highlight how critical grid reliability has become. Commentary points to a shift from upstream exploration toward midstream and downstream infrastructure, where connecting natural gas directly to high-demand users like data centers can unlock more durable value creation. These structural tailwinds coexist with, rather than replace, the current fossil fuel shock. Physical damage to regional energy assets, missed planting seasons, and disrupted commodity flows still weigh on the near-term outlook. Yet over a multi-year horizon, the need for more resilient grids, diversified fuel sources, and additional base metals for defense and infrastructure suggests an expanding opportunity set linked to the energy transition. On the bearish side, an unprecedented Middle East energy supply shock remains the dominant headwind. The closure of the Strait of Hormuz has removed roughly 10 million barrels per day of oil from the market, while broader disruptions have displaced up to 17 million barrels, around 17% of global supply. The International Energy Agency highlights that more than 40 energy sites across 9 countries are damaged or severely impaired, describing the shock as roughly twice the combined size of the crises in the 1970s and 2022. These headline numbers translate into very real pressures on consumers and corporates. Crude prices have at times surged 50% in just a few weeks, with December contracts approaching $90 and refined products such as gasoline and jet fuel moving sharply higher. Airlines are facing billions in additional annual fuel costs, hinting at higher ticket prices and squeezed margins, while elevated diesel and gasoline prices are expected to feed through broadly into goods and services inflation. The risk is not just inflation but stagflation. Higher energy costs are expected to disproportionately hit lower-income households, eroding real disposable income and weighing on U.S. consumer spending and housing. Asia and Europe look particularly exposed. Energy importers such as Korea and Taiwan face headwinds to equity performance, and European markets are enduring their worst month in several years as transport and fuel costs surge. There are mitigating factors, but none is a quick fix. Strategic reserve releases from the United States and allies, pre-positioned barrels outside the Gulf, and U.S. refineries running harder than usual all help cushion the blow. However, structural damage to LNG facilities, partial depletion of strategic storage, and continued closure of key export routes mean that reopening the Strait of Hormuz and repairing infrastructure are the only true solutions, leaving a persistent risk premium embedded in energy markets. Hawkish rates repricing and higher yields add a second powerful bearish force. Short-dated bond yields in the United States, United Kingdom, and Europe have moved sharply higher, with some markets seeing 60 to 100 basis points of increase over a matter of weeks. The U.S. 2-year yield has pushed back above 4% for the first time in months, while UK gilts and European government bonds are trading near multi-year highs in yield terms. Central banks are signaling a stronger focus on inflation risks, especially as recent gasoline and energy shocks have stalled progress toward 2% targets. Markets are now pricing multiple additional rate hikes from the European Central Bank and the Bank of England, and some analysts see a growing chance that the Federal Reserve could hike again later this year. Even where explicit hikes are not delivered, less accommodative policy settings and reduced expectations for rate cuts amount to a de facto tightening in financial conditions. Higher yields have direct implications for risk assets. Equity valuations, particularly for long-duration cash flow sectors, face a higher discount rate, while tight credit spreads no longer offer much compensation given rising default concerns in private credit and stress in some bank and sovereign markets. Credit spreads in high-yield and corporate bonds have already widened by around 60 to 70 basis points, and periphery European spreads, such as Italian BTPs versus bunds, are approaching levels that could draw central bank attention. Headline-driven geopolitical volatility and fragility complete the bearish picture. Markets across equities, bonds, oil, and precious metals are being whipsawed by rapidly shifting narratives around U.S.-Iran tensions and the status of the Strait of Hormuz. Single social media posts and unverified reports of negotiations have triggered intraday swings of several percent in major indices, as rallies on de-escalation headlines give way to sell-offs when official denials emerge. This environment is straining both liquidity and confidence. Perceptions of manipulation and mistrust in price signals are discouraging active trading, particularly in Europe, where equity markets are suffering their worst month in years and volumes are thin. Bond and commodity markets show similar patterns, with extreme moves in crude, sharp reversals in yields, and multi-session declines in gold and silver as investors deleverage and raise cash. The path for risk sentiment is therefore highly path-dependent. Commentators highlight the next few days as critical, as the outcome of U.S.-led negotiations and the ability to control field commanders on the ground will determine whether de-escalation holds or renewed escalation forces another repricing. Key signposts include any concrete progress on reopening shipping lanes, clear evidence of reduced drone and missile attacks, and more consistent communication from policymakers. Until then, elevated volatility and fragile positioning are likely to remain defining features of the cross-asset landscape. To sum up, risk sentiment today is cautiously risk-on. De-escalation hopes and resilient U.S. tech are lifting equities, while structural themes in LNG, power infrastructure, and base metals provide longer-term support. Set against that are three stubborn headwinds: an unprecedented Middle East energy supply shock, tighter global financial conditions as yields reprice higher, and a highly fragile, headline-driven volatility regime that can reverse risk appetite in minutes. Watching how these forces interact around the reopening of key energy routes, inflation data, and central bank messaging will be crucial for understanding where risk premia and cross-asset correlations settle from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.